We're pleased to welcome now the president of Element Wealth. It's Jeremy Nelson. Jeremy, thanks for coming in.
Always a pleasure, Gerard.
So you and I were just watching these markets that seem to be hanging on every word coming out of the Trump administration, and it's like that's driving markets more than the fundamental technicals which we typically expect would drive markets, like profit, you know. So
well, yeah, I mean, I think if you recall, it was 2 weeks ago or so, I was here, and one of the things I said was everyone needs to take a chill pill. Right. The markets were down. Don't panic. I mean, and now we've kind of seen a little bit of a recovery here.
Yeah.
But the markets were really panicked because President Trump and his administration were kind of saying, hey, we're not looking at the stock market. Well, then the stock market really started to sell off. It was quite concerned. And now we're starting to see a little bit of a change in tune. Some of the commentary that's coming, out of the president is, no, we don't want to fire
Powell.
And so they're starting to react a little bit more. Obviously, they reacted when the 10-year Treasury jumped and kind of backed off some of the tariffs. So they are seeing what's happening in the markets. They are reacting a little bit here, and the market's kind of taking a little bit of a breather right now from the selling.
That's what we're seeing. We got the Dow up about 400 points or so, and the NASDAQ up equally as much. And I think a lot of that's driven by news that First Treasury Secretary Scott Bessent yesterday said the current situation with the U.S. and China is not sustainable. He actually said unsustainable was the word he used. And the market said, okay, that means they're pretty serious about getting a deal done here. And the markets reacted positively to that. I think that was the big news, but then the regime over at the CCP says, no, we're not in any discussions, and the market kind of said, okay, because we were up at like 1,100 points at one point yesterday. Yep. We ended up closing at 400 or something.
It faded off, and obviously we don't know exactly where those conversations are, but I don't think that China's just going to cave and roll over instantly on this, and I don't think we're going to cave and roll over instantly. I think that this is a negotiation and a conversation. I would say it's happening. I mean, I don't see any way that it's not happening, but I think it's going to take time to come to some sort of a compromise on what a deal and a framework is going to look like.
Do you think the market's overreacted to this deal?
No, because my opinion is that the froth has come out of the market. Right?
Okay.
We just got to overvalued levels, and we talked about that a lot at the end of last year where, look, the market's just expensive. We're still expensive. We're just not as expensive. So what I see is just a little bit of risk-taking coming out of the market. I don't think we've priced in the probability of a recession or that this is going to drag on. I think that the market is actually digesting this relatively well right now.
Yeah, okay. Well, it almost feels like perhaps the market knew it was overvalued, knew we had froth, and was just, as it always does, looking for some news nugget to drive it out of it.
Yeah, I think that what you're seeing is institutions are lightening the load, right? And so we're getting a little bit of a rally here. A lot of it is retail flow, some short covering in certain positions. But I think that what you're going to see is as we get these rallies, you're going to get it. They're going to fade off here because there's still a lot of question marks, right? We're kind of getting to this point of a coin toss on is there going to be a recession or not. And so I think you're going to see institutions use strength to sell and lighten the load a little bit. And so I think there's going to continue to be a little bit of whipsaw here.
Well, from just from a technical perspective, the thing that puzzles me a bit is that we have a $28, $29 trillion, $30 trillion GDP, and we import total about $3 trillion. It's 10% of GDP. Maybe I'm not looking at that right. Maybe that's not a valid ratio, but how could that have such a massive impact on markets?
Well, because little changes matter, right? So, again, if we think about it from the perspective of the tariff, right? The tariff is a tax, okay? No matter what anyone says, it's a tax, and it's not paid by the exporting country. Right?
Contrary to popular belief.
It's paid either by passing it through to the consumer or corporations eat it and it hits profits. Well, if it's passed through to the consumer, it's inflationary. Now, I don't think Like some people are talking about this is going to create runaway inflation. That's stupid. It's not going to. But it causes some inflation. And we're still at that point where we haven't hit the Fed's 2% target
of inflation.
And so it hurts the market from the perspective that interest rates have to stay up a little bit higher. The Fed can't be as aggressive in cutting, right? And so if interest rates are up, valuations on stocks come down, or corporations eat it, and now it's hitting corporate profits. So that's why little things matter to the market, because it adjusts valuations.
The market, though, feels like it's pricing in some sort of rate decrease in June.
The market is still expecting that we are going to get at least 2 rate cuts this year.
Okay.
And I think that that's probably a pretty good base case. I don't think we're going to 2%. I don't think we'll get all the way to 3 by the end of the year unless you had some economic damage. But, all things being equal, you are seeing you're seeing consumer sentiment really shifting negative, right? You're going to start to see, especially in this second quarter, consumption coming down a little bit, which ultimately does help with inflation. It does give the Fed a little bit of cover.
Yeah.
But I don't know that it's going to be enough that it's going to trigger this big recession at this point in time.
All right, so you had some earnings reports coming in, and we were expecting a lot of the big tech guys to be reporting here. Today? We got some coming in
There's
today?
There's going to be, today and throughout next week. Yeah.
Okay. Yeah, so that, everybody's highly focused on that. But we get an American Airlines coming in. Now, that's a stock that trades for, $9, $10, something like that. And they are following suit behind several other big public companies who are saying, we can't give you any guidance. I think it was United that gave 2 sets of guidance. I've never seen that before. If this happens, this is what we think the company, how it's going to perform. If this happens, this is how we think the company's going to perform. This is crazy. No guidance. How do you buy stock in a company that doesn't issue guidance?
Well, that's the challenge, right? And you saw Procter & Gamble come out, right? And they issued negative guidance, right? A lot of uncertainty. Now, why that matters is that it hurts hiring. Yeah. So at the same time that you're laying off a lot of government workers, corporations are holding back on hiring or potentially going to start layoffs because of the uncertainty. And we kind of get to this point where everyone just gets stagnant in a standstill.
They're frozen, paralyzed.
Because we're just waiting to see what the rules are going to be. And there's been some flip-flopping on it thus far, right? We're having these tariffs, then we're not having these tariffs, right? And we started out with Canada and Mexico, and then it was the rest of the world, and then we backed off of it for 90 days. And we haven't had any major deals announced at this point in time, right?
Right.
And so I think that corporate America, and I think consumers are kind of going, whoa, we just need to slow down a little. And that's why I do think we are going to see a slowdown in GDP growth. Not necessarily a recession yet, right? But you're going to see GDP growth rates slowing a little bit.
Well, and that's even most of the Fed governors are predicting that as well, right? Some are even predicting a contraction. However, Kevin Hassett, he serves as the head of the Council of Economic Advisors. He's saying 100% no way a recession. So, of course, like all economists, we got 2 different opinions here.
What people have to realize is that 68% of the economy is consumption, but 70% of that consumption is on services.
Right.
And that makes it very difficult, absent a shock like a COVID or a financial crisis, to see a recession in the United States.
Yeah, that's a good point. And which is why I think that there's a lot of misunderstanding about the manufacturing and its relationship to the overall economy. It's not what it was 50 years ago, not because manufacturing has shrunk. We've actually are producing more in this country now than we were 50 years ago.
Because of labor productivity and technology.
Right. But we have created this whole new series of services, and we've just had this massive expansion of the services part of our economy, too driven by technology and innovation.
Absolutely. And the other thing that I would point out is, we had balanced trade. Now, one thing I think for our listeners to really understand about this trade deficit is in my mind, you got to look at goods and services.
Yeah.
And we are a massive net exporter
of services. It's totally right.
But we've had an economy where in 1960 to 1983, we had balanced trade with goods. Household net worth growth has been higher since we've had the trade deficit because that money comes back in the form of foreign investment.
Yeah, that's so true.
So there's counters to all of this stuff.
Yeah, I agree. We got Jeremy Nelson. He's the president of Element Wealth. We'll continue this discussion on the other side of the break from the Element Wealth studio. Visiting with Jeremy Nelson, president of Element Wealth. So the market's looking for some clarity at this point, more than anything, and it feels like the announcement of a deal, signed deal, right? It's just talking about it helps a little bit, but nothing like, I think, the reaction we would get if we got, as they say, pen to paper from two parties on negotiating a trade deal.
Yeah, I think that's the key is that, the market right now is saying, okay, we're in this 90-day holding period, and then we've even exempted a lot of things with regard to technology. And the market's saying, okay, we got 90 days here. They're going to get something done. They're indicating that conversations are happening. And so the market's kind of patiently waiting here to see what happens. The longer it drags out, though, and the closer and closer you get to that 90 days, it starts to get a little bit more tumultuous, right? Because now, are we actually going to get something done?
Okay.
Are these other countries creating their own trade deals, right, to be less reliant on the United States, right? So I don't think that we want to get left out of this. Ultimately, the president is 100% correct in that we have to do something about this trade imbalance.
Okay.
Right? 100%. Are we going to get to a balanced trade relationship? Probably not. And do I think that we end up with some sort of a tariff system, maybe similar to what the EU has, where it's minor, right? But it would help in raising revenue for the government to offset some of the deficit, right? But what we just don't know is, are we going to get there?
Yeah.
And the harder that we press and the uglier that we are about it, right? It starts to turn those foreign consumers away from wanting to buy U.S. goods as well, right? So even if you get to a point where you said, okay, we've got this great trade deal, are Europeans going to buy American autos? I don't know, right? I don't think you're going to see Chevy Tahoes rolling through the streets of Rome,
right?
It's just probably not going to happen. So, diplomacy in this is important. And I think we're getting to that point where it's a little bit more diplomatic now. I think the temperature is cooling a bit, but we do need to get something done here in quick order, because otherwise the markets will start to worry again.
Yeah, right now they're sort of taking a bit of a respite, I would say, just because there's been more positive than negative news on this front of late. When we went through a period of more negative than positive, of course, the markets sold off. But there are a lot of people, that are considering retirement, and they're looking at the balances in their accounts, their nest eggs that they hope to use and to fund their retirements, and they're understandably worried. What would you say to them?
One, we will get through this, right? Like, period, end of story. And what you have to remember is that you're not liquidating your entire portfolio all at once when you retire. Okay, so you don't have to lose so much sleep. Like, your nest egg isn't going away. It's fluctuating, and it's fluctuating a little bit more than usual right now. But you should have things in your portfolio, like bonds, like some emergency savings, to where you're not forced to sell your growth or your risk assets while things are down. This is why diversification is the only free lunch, right? And so if you're looking at your portfolio, though, today, and you're seeing price fluctuations that you're not comfortable with, well, one, the markets are back up. This is a great opportunity to really do a risk assessment, see where you are, look at potential alternatives. I'm quite optimistic because over time, I fundamentally believe that U.S. corporations are going to figure out how to play the game. And they're going to make more money. So in 10 years from now, I think U.S. corporations are going to make a lot more money than they're making today. Now, yes, in the intermediate term, in the short term here, there's going to be some turbulence. But you got to remember, like when you own stocks are that longer duration, longer term asset in your portfolio. They're also the more volatile piece of your portfolio. So this is why you need to be diversified.
Yeah, that makes total sense. And that's pretty consistent with the message I'm hearing from investment bankers, wealth managers, economists.
Yeah.
That's pretty much the message.
If you're trying to trade this, good luck.
Yeah.
Because you don't know what Truth Social post or tweet is going to come out that's going to send the markets the other way.
Yeah.
Right. So trading this is troublesome because, again, I mean, you just don't know from one day to the next what the headline's going to be and how the market's going to react. We're seeing a lot of volatility. There's still a lot of money that was printed that's sitting out there and trading right now. You know, 2021, or 2020 with COVID was kind of this real fundamental change in markets where trading and retail investing came back, and things have been pretty wild, right? Yeah. And so as you're creating a retirement plan, you need to kind of cut through the noise, cut through the emotion, be intelligent about what you're doing. And if you do that, it's going to be okay. Look, we got through the dot-com bubble busting. We got through the financial crisis. We got through COVID. We got through 2022, right? We're going to get through this. But being emotional and reacting is what will get you in trouble.
Don't you think there's some folks out there, though, that perhaps had planned a date certain for retirement that may be putting it off now as
100%.
a result? Yeah,
100%.
That's happening.
I mean, if I was, I'd be holding back a little bit right now.
Yeah.
Absolutely. I mean, as we're building plans out today, I mean, we're looking at balancing income growth guarantees, and we've got this scenario analysis that we're looking at where, hey, if this is the beginning of a secular bear market, which this could be, where markets aren't going to be as favorable for the next decade, how are we going to handle that, right? But that's where you got to do the planning and make educated decisions, not emotional decisions.
Let's talk about the dollar. I don't know that I've seen so much controversy, so much discussion about the dollar, and I do think that's one of the things that the president's inner circle cautioned him about, which is one of the reasons I believe he ended up pausing the tariffs. But explain that to the audience, why that's important and how the dollar's value fluctuates against other currencies.
So the dollar has been strong post-financial crisis. Right. So for the last 16 years, we've kind of been in a dollar bull market. It's gotten to a point, though, where, hey, it's great if we go travel abroad because our dollar goes so far. It's great if we're buying foreign goods because our dollar goes so far. It hurts our exports, though, because it makes our goods more expensive.
Takes more of their currency to buy.
Now, there's two trains of thought. Like Ronald Reagan was a king dollar guy. He wanted a strong dollar, right? Because we were the reserve currency. That showed strength. I would argue the dollar's probably a little bit too strong, and it's hurting us to a certain extent right now. And so you're starting to see the dollar fade versus the euro versus the pound. You know, I think we were almost at parity on the euro, and now it's like 113.
Yeah.
So it's been a sizable move. What you want to understand here is from an investing portfolio, you might want to think a little bit more globally in your equity allocations. One, international stocks trade at a significant discount to U.S. stocks. So it's cheaper to buy those earnings. But two, if the dollar starts to weaken further, you're going to see strength. And we're seeing it thus far this year. Relative strength in international investments for U.S. investors. If you go back to 03 to 07 or 08, international stocks basically doubled U.S. stock performance in that recovery. And it was on the back of the dollar weakening.
Mm-hmm.
So this is where within your portfolio you might want to think a little bit more internationally or globally. Doesn't mean go all in, right? But if you look at something like the MSCI All Country World Index, it's about 67%, 65% U.S., right? So maybe you want to be 70-30, 80-20, something like that. You want to get those international assets in because it's going to diversify you a little bit better. And if the dollar does weaken, that part of your portfolio is going to perform quite well.
Makes sense. So there was some concern, and I was one of them, about possibly the White House signaling they were in support of creating a new tax bracket and imposing more taxes essentially on all income over $1 million. But the Speaker of the House made it clear the last 24 hours, no, he's talked to the White House, we're not going to do that.
I think you want to avoid that as much as possible. You have to get into the idea of the marginal propensity to consume, though. The more tax relief that we have for middle and lower income families, they're going to consume those dollars, right? Whereas, somebody who's making $5 million a year, you cut their taxes, they're just going to save it. They're not going to consume it. Right?
But raising taxes on them may have
raising taxes
negative.
Hurts their consumption.
No doubt.
So what you need to do is you need to hold those tax rates, not increase them.
I agree. I think that's where we're headed. Jeremy Nelson, president of Element Wealth, has been our guest in the Element Wealth studio. Always good to talk to you.
Always appreciate it. Thanks, Gerard.
Coming right back, folks. Stay with us.